Okay, this is Order Flow Trading Course Lesson 16, Order Flow Reversal Setups. My name is Michael Baltos. I'm the founder of orderflows.com. I will read through a brief disclaimer real quick. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. CFTC Rules 4.41 state hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. Okay, let's begin. Order flow reversal setups. There's a saying, the trend is your friend. But like most relationship, the trend and often reverses. Everybody, every trading book says go with the trend. The trend is your friend. But no market moves in one direction forever. Even if it is a pause and a pullback in existing trend, there are still profits to be made. So, there's a lot of opportunities in the market. You have a trend stops, it reverses. You can often get very good trading opportunities at these reversal areas. But before I go into details about reversal patterns, let me preface it by explaining that a reversal does not always mean that the current uptrend or downtrend will reverse in that direction. Rather, the current direction may end. The market can then drift sideways. Order flow must be viewed in context of the market to be effective. If you're in the middle of the range and the best trading setup happens, it may not be effective. So, I said, take everything in context of the market. Don't think that, just because you have a trend and it ends, it's beginning of a move in the other direction. The market can just go sideways, or it can pause, go sideways, then go back up. It's really, the market's unique. There's no one way to approach the market that's going to cover every scenario. Order flow will help you, catch those periods where, there's an opportunity to make some money, at least in the short term. So why does the market reverse? At market tops, traders get greedy. At market bottoms, traders get scared. Both sentiments lead to market extremes. What that means is, at market tops, people keep buying. They think it's going higher when it's not, because, everybody wants to make money thinking they're going to buy low or buy high and sell higher. Or at market bottoms, people are scared. Their position is against them, and it keeps going lower. And, in the end, they just, add fuel to the fire and, sell until, they're out of their position. And then more often than not, what happens? The market turns, right after these guys that are scared close their position. So when is the market most bullish? Well, it's most bullish when it's trading at its daily high. When, as prices move up, everybody wants to get involved in the move. They're going to be buying. That happens till, everyone is long. Once everyone is long, there's no more buying to sustain the move up. And what happens? Price, drops under its own weight. Once price stops to drop from the high, profit taking and covering of longs help to accelerate the move downward and the market rally ends. So, as a trader, you want to look for clues that the sentiment of the market is changing, that there are not enough buyers to sustain the move higher. Okay, so for example, here's a chart of the market was moving up. You get aggressive buyers on the way up, buying imbalances 196, 200, 500, 1000 right at the high. Can't get past this level. What's the market telling you? You have people being aggressive, but they can't move the market any higher, and what happens? The market sells off. So when is the market most bearish? Well, a market is most bearish when it's trading at its low for the day. As prices move down, everyone wants to get involved in the move and they're selling. That happens until all the bears are short. Once everyone is short, there's no more selling to sustain the move, and what happens? Prices start to tick up as buyers look for sellers. Once prices start to rise off lows, short covering often appears, and traders who sold on the move down start buying the offers, and the market starts to gradually move higher. Order flow will allow you to be quick to detect the changes and go with the newly formed trend. The market is reversing. It's going down, stops. Now all buyers are coming in and, reversing the trend. You're seeing a shift in, from a supply-driven market to a demand-driven market. A supply-driven market, prices will go down. When it's demand-driven, prices will go up. So here's the case. The market is going down, down, down. You hit the low. This is the red line here. Where's the continued selling? You got one lot traded, at the low, which was the same low from a little bit earlier, but the market couldn't get past it the second time. And all of a sudden now you're starting to see the buying come in. You're seeing buying imbalances come in. And, the delta is showing you net positive buyers as, you start to move off from the low. So certain order flow patterns emerge at the ends of trends when the market has been trending, so you can look for possible reversal. So, know that the market has been in a trend, so when you start to see something in the order flow that's a reversal signal, you can know that it's, setting up to reverse. So when prices are trending higher and higher, the potential for a reversal are bigger. When prices are trending lower and lower, obviously the potential for reversal is bigger, because at some point it's going to stop. You throw a ball in the air, it's going to reach the point of inflection where it stops and begins its ascent, drop downwards. So what are the reversal setups that I'll talk about here? Single prints, small prints, large prints, stacked imbalances, divergence, and extreme imbalances. Again, trend is your friend. Earlier I said that. But when the trend ends and reversal patterns occur, a new trend will start. So, that's why it's important to look for reversal patterns in the market. But first, before you can look at them, you have to understand them. And, it helps to understand the logic behind them. You see a lot of trading books, and they'll say, oh, this setup is a reversal pattern. Well, they don't really tell you why it's a reversal pattern. Order flows, you can see why. You can see the psychology in the market that explains to you why it's a reversal pattern. So, the first one, I'll talk about single prints, bullish single prints. After a move down, a single print at the bottom of a up bar or green candle indicates selling interest has dried up. The market lacks follow-through, selling to go lower. Selling interest has gotten very weak. So, again, this is why it helps to have the order flows trader software, because you're only going to be alerted to it on the order flow software. If you didn't have the order flows trader software, you just have a normal footprint chart. Maybe in the future other software will add this into their systems, but I'm the first one to really explain it and talk about it and bring it to the public. And what you have at the bottom of a green candlestick, when you have a single print, a single print is a number between 1 and 9. It's a single digit. It'll put a box around it, so it's going to indicate to you that there's a single print at the bottom of a green candlestick. If it was a red candlestick, that would be a bearish sign. But what it's telling you is that the selling has really dried up at the bottom of this. Usually, to me, it's a sign of price rejection. There's no more interest to sell it here. So sellers are rejecting prices below this level, and prices move up. Like I said, I like to take it in context of the market. If the market is just going sideways without any clear direction, and I see a single print, I'm not that interested in it. Where if I see it, the market has made a move down, and I see a single print on a green candlestick, I'd be interested in it. Because, they said take everything in context with what's going on in the market. Don't just take it because it's there. So a bearish single print, after an up move, a single print at the top of a bar or a red candle, top of a down bar or a red candle indicates buying interest has dried up. The market lacks follow through to go higher. Buying interest has gotten very weak. So here you see it. it's up at the top of this red candle, which is on the green candle. It'll appear on if it's in the bottom left, but on the red, it's on the top right. And so buyers are rejecting these higher prices. They're not interested in taking it higher than this level here. And the price of the bar, it turned lower, and the bar closed lower. That's why it appears on a red candle. It appears on the top. On the green candle, it would appear on the bottom. Small prints, bullish one. After a down move, a small print at the bottom of an up bar, or should be green candle. Indicates that selling interest has dried up. The market lacks follow-through selling to go lower. The small print is determined by the ratio traded on the bottom of the bar with the volume immediately above it. So here you have the green candle. So it opened here, closed up here, and down here you have a ratio of 59.92. If it's a blue number, it indicates a small print, a ratio above a certain level that I use to determine what is a small print. Here you have a black number, so the ratio doesn't indicate to me that this is a small print. But what it's indicating, it takes the difference between the volumes of the price levels here to give you this ratio. And so if it's a ratio above 30, I like to consider that a small print. It means that, the volume down here was relatively small relative to the volume just above it. Whereas here on this next bar, it's kind of an average number. I want to see where it trades, say 15 lots against 1,200. That tells me that there's, prices being rejected down here. Sellers aren't interested to sell down here. Okay, now a bearish small print, again, it's the opposite of a bullish small print, only it will occur on a red candle. So after an up move, a small print at the top of a down bar or a red candle indicates buying interest has dried up. The market lacks follow-through buying. For the market to go higher, the small print is determined by the ratio traded on the top of the bar on the upper side with the volume immediately below it. So here you have a ratio of 28.53. I have my settings set at 28. So here you have the ratio 17 into 485 gives you a ratio of 28.53. So it's telling you that, it's a red candle. You're going to know it's a red candle if the ratio appears above it. You'll know it's green if it appears below it. But the number itself, if it's blue color, it'll tell you that it meets your requirement. I use 30 as my ratio. So anything, I'm looking for numbers above 30. However, I have my settings set at 28, particularly because I want to see numbers like this, 28.52. It's not a line in the sand where it has to be above this number or below this number. My cutoff is around 30. So, if it's 29.12, that's very close to 30. I want to look at the individual numbers themselves. It's more of a guideline, but, definitely if it's above 30. But if it's a number between, 28 and 30, I'm also interested in taking a look at it, further review. Okay, the next one is large prints. Bullish large prints appearing at the bottom edges of a move down are indicative of strong passive buyers appearing in a down move. Aggressive sellers can't move the market through the price level where the strong passive buyers are sitting. So you guys see that as a ratio. Again, it's going to be blue. Unlike a small print, it's a different type of number. It's going to be a number closer to 0, usually a number between 0.69 or 0.7 and 0, which will indicate that there's heavy volume at the very bottom of the bar. Now, it's not something you see very often. Over the course of a day, you may get only a couple of bars like that. But when it happens at the end of a move, it's very important. It's telling you there's a strong passive participant there who's willing to support the market. Now, large prints appearing at the top of an up move are indicative of strong passive sellers, like you see here. You have a ratio of 0.53. It's indicating strong passive buyers up here at the very top of the bar. These people have a lot of supply to sell. So aggressive buyers are not able to move the market through the price level where these sellers are sitting, so buyers can't get it any higher. Someone has a lot to sell and they're willing to hold down the market there. Stack selling imbalances around highs. Stack selling imbalances that occur after a recent high is usually a clear indication of a shift in supply and demand. Buyers have moved the market higher, but aggressive sellers have come in to overwhelm the buyers. Like I said, I like to take shorts near highs and longs near lows. You don't always get the chance, but I like to have reasons to do it. And if I'm seeing a stack selling imbalance near a high, I'm more inclined to take it than a stack selling imbalance near the low, because that's where you're going to see a shift in supply and demand. You're going to see shifts around the highs or around the lows. When demand, near a high, it's demand. You get up to the high, then all of a sudden there's supply, and the market sells off, and it becomes, supply side taking over. Then the opposite would be stacked and buying imbalances around the lows. A stacked imbalance, buying imbalance that occurs after a recent low is usually a clear indication of shift in supply and demand. It's gone from a supply market to a demand market. Sellers have moved the market lower, but aggressive buyers have come in to overwhelm the sellers. Again, we're working our way down towards this low area, and all of a sudden the buyers, sit up to, hey, this is a good deal, I'm going to buy some more. And everyone's aggressive and buying it, and the market moves higher. Should move higher. Divergence. Now, there's two types of divergence. There's bullish divergence. There's bearish divergence. Bullish divergence occurs when a new or equal low is made in the market. The delta is positive, and the bar closes higher than the level where it opened. Now, in a market that's trending, you're going to get divergences, either buying divergences or selling divergences. And I tend to like to not just take every divergence by itself. I like to get ratios involved in there. Like here, you don't necessarily have a ratio. You have an imbalance. I like to get a little something extra besides just divergence, because there are days when the market just seems like it's a one-way street. And, if you're trying to sell every divergence and the market keeps on rallying, you're going to end up in the poorhouse pretty quick. But, just for explanation's sake, a divergence occurs when you have a positive delta at a new low. You should have a negative delta at a new low. Now, a bearish divergence, again, it's the opposite. It occurs when a new or equal high is made in the market. The delta is negative. The bar closed lower than where it opened. So again, here's your new high. You have a delta. That's this down triangle, and you got a negative delta. Now, one of the things that makes my software a little bit different than most of the software on the market, it refers to divergences. Most order flow software will just say you have a divergence when you have a new or equal high and a negative delta, or a new or equal low and a positive delta. I'd like to take it a step further. I want to see price action in the individual bar confirm the direction of the market. So, if I'm taking a bearish divergence at a high, I want to see the bar close negative. I don't want to see it close positive. I don't want the bar to be trading up near the high. I'd want it to be closing negative. That's just, for me, just a little extra visual step as far as confirmation. Okay, so bullish extreme imbalances is when you have a bullish extreme imbalance. It occurs when there's a selling imbalance at the bottom of a bar that closed higher than it opened. On the order flows trader software, it's going to be highlighted with an arrow. In this case, you'll see the normal selling imbalance and the bar closed higher. You'll draw the arrow. To me, that's a sign that sellers were really aggressive at the bottom of the bar, and trying to push the market lower, but it couldn't go any lower, and the market popped back up. The opposite would be a bearish extreme imbalance, where at the top there is a buying imbalance of a bar that closed lower than where it opens. Again, here it's going to draw the arrow. My order flow software is the only software that I'm aware of that draws those arrows, that highlights to you. People say, oh, that's trap traders. It is and it isn't. And it's people that are long and wrong and can't move the market any further. Okay, so, bearish extreme imbalance when it occurs, and we look to get short. Right? It's a quick trade. It's a quick reversal. I don't expect these extreme imbalances, the bullish or bearish ones, to be really the end of a long-term trend or the start of a new trend. For me, the bearish extreme imbalances are more of a short-term indicator than a longer-term indicator. I said it'll occur at the end of a trend pretty quick, and you get a slight move, but I said it's not a pure reversal indicator that will indicate the end of a trend and the start of a new trend. Oftentimes the reversal indicator will signal the end of a trend, but doesn't necessarily mean that it's the beginning of a new trend. Divergence trading sounds great and straightforward, but there are caveats with it. Like I was talking about earlier, in a trending market, there's going to be a lot of divergences appearing. I like to get a little bit extra out of the divergence rather than just having a divergence. Because, say a market is rallying, right? But people are going to take profits at some point. You will get a negative delta, and, that'll kick off a divergence. I want to see price being rejected, so I want to see a ratio, just occurring either as soon as the divergence occurs or shortly thereafter. So in a rapidly trending market, there will be failed divergences, and that's just a fact of life. Divergences with single prints, small prints, or large prints are more selective and more powerful. When you're making new highs, you should see aggressive buying in the form of stacked buying imbalances. When you're making new lows, you should be seeing aggressive selling in the form of selling imbalances. Usually a shift in supply and demand is occurring and can be seen in stacked imbalances. So when you're seeing a stacked imbalance, by definition, what is a stacked imbalance? A stacked imbalance is usually 3 or more imbalances occurring on top of each other. Now, you can have, in a bar, you can have 3 imbalances, maybe they're not stacked on each other. It could be 2, then a normal price level, and then another one. But usually, visually, seeing a stacked imbalance is slightly more important because usually it's somebody that's buying it up through a level. And when I say a shift in supply and demand is occurring, when you see an imbalance occurring, a selling imbalance occurring at a high, think about it. What's happened? The market's rallied up, made a high as people were buying. The demand was there, but then you plateau at a high, and all of a sudden you see selling come in, and it's very aggressive in the form of selling imbalances. Well, the sellers have taken over now. They're laying off their excess supply in the market. The same is true for at a low. If you see a buying imbalance, stacked buying imbalance come in off a low, you're seeing demand pick up and demand being very aggressive. So, I said I prefer to take them in context of the market. I'd rather take a buying imbalance near a low, a selling imbalance near the high. Okay, so reversal setups. I'll just go through a bunch of examples here just to give you an idea of how to see them and catch them in real time. I like to plot the high and the low for the day, so I know when the market's going to reverse. I don't want to have to keep referring to something to see where the low has been or where the high is. Most software, NinjaTrader, which I use, has an indicator that will draw a line where the low of the day is, which is this red line. This thinner red line is yesterday's low. But for today, I do like to see how market reacts to the previous day's highs and lows as well as today's lows. So we made the low here, and what do you have? You have stopping volume. Ratio of 0.57. It's below 0.69 that I like, and the market reacted to it. Okay, so here's an example. We're working our way down to a low level. Coming down. You can see the market, the price action is moving down. You hit this low. You don't necessarily have a ratio here right now. It's an average number, 15. The market starts ticking back up. You get a buying imbalance. You came down, you hit a low, you're looking for the reversal sign, and here it is. Boom, you get the buying imbalance, and you got a ratio that you like. Okay, this is a mini Dow, the YM. It's a 3-minute chart. And what do you have? The first time you hit the low, you have that extreme imbalance you have the imbalance at the extreme of the bar. In this case, it's a ratio. You also have a divergence. You've got, it's like all telling you, all systems go. Boom. And you got a bit of a rally. Later, you came down, you hit the low again, you have a divergence. It did rally. I'm not necessarily, saying to take this divergence. I like to have some ratios. Some blue color ratio number down there, or, like this imbalance you have here. This one was, a decent one. You could have got 20, 30 ticks out of it, 20 ticks out of it. I'm not saying you would have ridden it all the way back down here and caught it on the way back up. But, realistically, you could have got in, 15, 16, traded up above 30. So, it's a fair trade. Again, this is the imbalance, but it's on the back of ratios. You got 3 ratios here. You're working your way down. Boom, you get some stopping volume. This a ratio bounds low, indicating some stopping volume here, followed by a single print, and you get your buying imbalance. So, really, this is the reversal indicator, and these are just confirmations, and the market just trades higher. Okay, you come up here. This is an E-mini chart. This is early morning, 5:30 in the morning. And you hit a ratio right up here at the high. It's indicating, relative to these numbers here, but it's indicating, some sort of volume up here to sort of stop the market. And the market came down. If you're not convinced what you're seeing here, you're seeing a stacked imbalance. Now, one of the things, I just want to point out is, a stacked imbalance is 3 imbalances in a row. But there's going to be bars where you have the imbalances, but you have them, spaced out. You got 265, and this one, 59, is not. 79 and 69. It's still imbalanced, but it's stacked a bit differently. It's just not stacked on top of each other in that sense. Okay, in this next one, working your way down, you hit the low, you got stopping volume, and the market rallies back up. You're going to see these things, daily. That's why you should have setups that you're looking for, things you're looking for in the market. Like I say, you want to see when the market reaches a low. How do you know this is low? Well, you got positive delta. It's your first sign of maybe the market's turning around. You have a positive delta. I said on the back of all these bars that are red, going down, 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 down. It turns, it's a green bar, positive delta. You have a ratio. It's telling you, hey, the market's poised to put in a little bit of a move higher. Okay, here's another one. What you have, you're at your low. That's this red line here. You don't have a ratio down here. You don't have a positive delta, but in the next bar, boom, you get the buying imbalance. I said I'd much rather take buying imbalances right off the low. You got the positive deltas appearing here, so the market moves higher. I said you're not always going to be able to pick the exact low. Like here, maybe you thought the market is going to go higher, but you have a positive delta. You didn't hit the low. But there's nothing in the next bar to get you excited. You hit the low here, nothing in this bar to get you excited. This is where you're going to get excited. And you're seeing the buying imbalances occurring even in the next bar. So it's, you got to read everything in context of the market. If you're looking for a reverse to happen, look for the market to be at the low. You want to have a trend to reverse. You got to look for areas where it's going to possibly reverse, and that's that could be the low, that could be the high, or a swing low or a swing high. Okay, so this is an E-mini chart. It's rallied up. Okay, again, nothing here in this bar, but it's the high of a move. That's important. So you want to see what's happening in the next few bars. That a reversal is going to come. Like I say, it's not always going to come boom right at the end of a move. It may happen a little bit after the move. Like I said, a reversal can happen and the market could go sideways. Then you want to see where the strength is going to come in. And you see it here with the selling imbalance. That's the strength in the market that's telling you the market's going to go lower. Don't think that you have to pick the exact high or the low of a move. Oftentimes the market hits a high or a low and goes sideways. Then, the sellers or the buyers are going to show their strength. That's what you want to look for. And, that's where you're seeing the change in supply and demand. Okay, this is a 10-year chart. 10 years are, markets that have tremendous volume sometimes make great examples for order flow. And what you're seeing here is you came down into low, you have a divergence, but I'm not necessarily convinced that this is the low yet. I'm waiting for the next bar, and boom, I see it here. I see the heavy volume at the bottom of the bar. I see the ratio that I like, 0.008. it's telling me there's heavy volume at the bottom of the bar. These extra buying imbalances is just icing on the cake, and the market traded higher. Again, the 10 years, this time, at the low, you do have the ratio that you like. You came down, down, down. You have this doji bar, and you have a very small delta. That's the first sign that things are starting to change. Then you get this small print down here indicating there's price rejection below here, and you have a buying imbalance. So it's telling you that, hey, the market, I'm getting ready to rally. Buckle your seatbelts. This is a Bund chart. It's a German 10-year chart. And you have something similar here. You came into the low. There's not necessarily anything here. The low is here, so, you're a couple ticks off. But the second time you hit that low, you did it on much less volume. And so you have a single print. It's a ratio. If you're not necessarily convinced that, okay, hey, the low is now here, in the next print, the next bar, you're seeing another single print. Now it's telling you, hey, idiot, don't miss this trade. I told you here with the single print that the market was rejecting the low. Now, I'm showing it to you again, don't miss the trade. So, I said, sometimes, you may see this bar here thinking, okay, this is the end of the trade. It goes up and comes back down again. Are you discouraged? No, it didn't take out the low. In fact, it just came down to the low, same level, but with much less volume. That's one of my, I'll say, bread and butter setups, but I do like to see when you test a low or test a high, the second time, and even to a lesser extent the third time, and do it on much less volume. Do it on a single print. I really love it. But, what you're seeing is, you're seeing the low come in, market goes sideways a little bit, and then it's showing you the change in supply and demand as the market starts to move away from that low. Okay, lastly, this is a Bund chart again. The market's coming down, working its way down, making new lows, making new lows, making new lows. Boom, you hit the low. You have a divergence, a small positive delta. It's not the strongest positive delta that you'd like to see, but it's positive nevertheless. Again, you have a single print, so you're kicking off a nice ratio. And the market starts moving higher. Maybe you're a little bit scared, getting long off this bar because you see this big negative delta, and you just have a small positive delta. This next bar, and even this bar here at 226 with the small print, giving you the ratio of 31, is indicating, hey, sellers aren't interested in pushing the market any lower. In this case, the buyers are taking over, and the market's going higher. So that's the end of lesson 16, reversal setups. In the next lesson, I'll explain how to spot and trade order flow continuation setups. So, like I said, I tend to split up reversals and continuations, but I'm always looking for them. And, I try to take advantage of both reversals and continuations during the trading day. So thank you, and I'll see you in the next lesson.